Good afternoon, everyone. Good afternoon, good afternoon.
Good afternoon.
Good afternoon.
All right, welcome to the first of our monthly webinars. We're 2 minutes beyond the start time. We will give others another minute or two to join, and then we will start. My panelists are looking prepared. Yes, beautiful. All right, so in another minute, we'll start. We have a very tight schedule. We must complete the schedule because it's very interesting. So let's give others a few seconds. Okay, it's time to go. Welcome again, everyone. My name is Jermaine Williamson, president of the Association of Land Economy and Valuation Surveyors, and I am one of 10 executives for the 2022-2023 Executive Council. We will want everyone to feel welcome, and we will just run through some housekeeping matters to get everyone on the same page. So before going to the housekeeping matters, I want to just say a big welcome to my panelists. We have, and I will speak more about them in detail when I'm introducing them for their presentation. But we have with us Dr. Sariye Akçay, and you'll see her on the screen right there. We have Dr. Wesley Hughes. Is Mr. Hughes, Dr. Hughes camera on? We also have Dr. Tina Beale, one of our own. Yes. We have Mr. Andrew James, another fellow valuer. And we have Miss Diane Campbell. So I'm asking all my, yes, Miss Campbell's camera is on, Dr. Hughes' camera is on, and we have Mr. Lloyd Davis, who will be speaking to us about the association. His camera is also on. So feel welcome, and it's very good having you all on board. We have a power-packed panel where we expect to get some very good information today. I want to welcome all the attendees the numbers are extraordinary. They're signing up, and the admission I'm not sure if all of you can see, but the admission is great. People are checking in, and it shows that this topic is very, very, very important to all. So I can move now to the housekeeping matters, and you will notice that the mics are mute and the cameras are off for the attendees. We want to place focus on the panelists. If there are any challenges, feel free to reach out to the administrators. We're going to use the chat so you can share any challenges you're experiencing in the chat, and we have technical support to sort out those challenges in shortest order. We're recording the webinar and it is being streamed live. So you would have seen that notice when you signed in. We're offering a live caption feature on all our webinars. You can access this feature by clicking the caption at the bottom of the screen. Screenshots will be taken during the session today. If you prefer to have your screen excluded from any product we may create, or please send an email to ALEVS with the request indicating what was on your screen. Please be present and engage in the webinar. And for the final bit of housekeeping matter, please be respectful of others, other people's feedback, opinion. There is no question that is a bad question. All questions are good questions, all right? Questions will be addressed primarily in the Q&A session. So please jot down your questions so we don't miss any of them. We will try our best to address as much as possible in the Q&A. And if it is that at the end of the presentation, someone wants to verbalize a feedback, then you could use the raise hand feature. All registrants received an email with a link to some files. This will be available up to 5 days after the event. Please download if you wish to save them. All right. So those are the housekeeping matters. At this time, I'm on the floor already. So the message from the president's desk? No, we're not there as yet. At this time, I will introduce Mr. Lloyd Davis, who will be giving the background on ALEVS, that is the Association of Land Economy and Valuation Surveyors. We are not in attendance today. We have a wide cross-section of people, not just from the land economy and valuation profession. So it's important that Mr. Lloyd, give this background so people can understand where this all started. So over to you, Sir Davis.
Thank you, Mr. President, and good afternoon to everyone. My task is to give a very brief background to the Association of Land Economy and Valuation Surveyors, an association which began in April 1974 and has been actively engaging professionals who are referred to as estate managers, land administrators, land economy surveyors, valuation surveyors, real estate appraisers, or general practice surveyors. The aims at the time were to develop a high standard of conduct and practice amongst members, and to facilitate knowledge sharing and ongoing discussions of matters pertaining to local and global practice. Some of our notable contributions over the years as a body and through our individual members are including the contribution to the development of the Real Estate Dealers and Developers Act, the development of the diploma and later the bachelor's program in land economy and valuation surveying at the University of Technology. We have close linkages with the Commonwealth Association of Surveying and Land Economy, CASL, the Royal Institution of Chartered Surveyors, RICS, the University of Technology, Jamaica, the Construction Industry Council, the Real Estate Board, and the Realtors Association of Jamaica. Today, ALEVS proudly celebrate 48 years and a legacy of professionalism in Jamaica. We are less than 2 years from 50 years old. And I know many amongst you are looking forward to the next 50 years. With a network of over 100 members and valuation supporters, we can be found in public sector organizations like the National Land Agency, the National Housing Trust, the Urban Development Corporation, the Planning Institute of Jamaica, National Health Fund, Tax Administration Jamaica, and the University of Technology. In practice, in the private practice, the sector in real estate companies conducting appraisals of all use types, managing property portfolios, managing property auctions, and conducting sale or lease transactions. And you can say that anywhere land is the subject of management, you are likely to find somebody from this association there. Mr. President, I hope I have not spent more time than was anticipated. Thank you very much.
Thank you, Mr. Davis. Thank you, thank you. So now that all our attendees are up to date with where we all started and what's happening, where to look out for our members, now we can move to the message from the president's desk, which will be much shorter than Mr. Davis's part just now. Well, let me just start by thanking all the previous ALEVS councils for setting the groundwork. Most recent, the 2021-2022 council led by Mr. Ryan Taylor. They have put in place the groundwork that is necessary for us to move forward. A lot of the plans that were on the books for that exec remains on the book for this exec, and we endeavor to execute on some major projects, some which includes the Constitution, the amendment of the Constitution, and the rollout of that important document. My team is comprised of 10 members, including myself. I can say that these persons are committed, and we are working all to our strengths to have this association thriving. We are operating under a theme, bridging the gap to secure the future. And pretty much what this is saying is that we will have one united valuation community. Some things to look out for, initiatives. We are very serious about increasing the awareness of the association. So sessions like these will be held monthly, and we will be inviting the general public because the information here will be impactful for anybody handling any real estate matter. We will also increase our presence on the social media platforms, and we will lend, as per usual, technical support to our members so that we all can be more efficient and effective in the execution of our duties. So that is the message from the President's desk, and we will now move to the mouth-watering part of the agenda, where we will welcome our speakers or panelists, and they will get straight down in the topic. The title of this webinar is The Impact of Rising Mortgage Rates, Interest Rates on the Real Estate Market. A lot of us on this program, if not all of us, are very, very, very interested in this topic. And today we hope to bring shed more light on this topic and give some ideas of what to expect. So at this time, I will open the floor for Dr. Sariye Belgin-Akçay, and I'm going to tell you a little bit about Dr. Akçay. She's a lecturer in the Department of Economics at the Ankara University, Turkey. Her expertise is real estate finance, housing policy, economic integration of the EU and EU-Turkish relations. She holds various degrees in law and economics and is the holder of a PhD in real estate and planning from the Henley Business School at the University of Reading. She serves as a senior economist for the Turkish government and has published extensively in high-ranking economics and real estate journals. I think the full bio was shared. We wouldn't have the time to go through all her accomplishments, but she is a very experienced speaker. I want you to help me right now to welcome Dr. Akçay to the floor.
Hi, everybody. Yes, this is Sariye. Firstly, I would like to thank for the invitation of ALEVS. Today, our topic is the impact of raising mortgage interest rates on housing markets. But as a first speaker, I would like to short introduction relating to the reasons of increasing mortgage interest rates. Yeah. Since the beginning of the 21st century, the world has witnessed two important global crises. The first is the 2007 and 2008 global financial crisis, and the second is the COVID-19 pandemic crisis. The pandemic quickly disrupted business activities, as you know, and with administrative closures and rapidly rising rates of infection, the domestic economies have been seriously affected in most of the countries. The COVID crisis has also created many uncertainties like other crises. One of them was the effect of economic shock on the housing sector. With closures implemented by the government, continue this slide, with closures implemented by the governments around the world, economic commentators were warning about the possibility of high decreases in house prices in many cities in the world. However, many countries have experienced a quite different story. Increasing prices in housing markets have emerged in many countries. For example, please continue. For example, in the United States, in South Korea, in many countries of the European Union have high housing price increases. With spreading the COVID pandemic, governments have taken short-term measures in many countries. For example, low interest rate and increasing loan supply, increasing public spending. There is typo. In addition to administrative lockdowns, with easy monetary policy implemented in most of countries when the pandemic started, mortgage interest rates decreased and loan supply increased. The existing literature showed that decline in real mortgage interest rates caused an increase in house prices during the COVID pandemic. Because low interest rates increase the affordability of households and then the housing demand and the size of mortgage loan borrowed increased. In addition, these developments have increased private demand as well as general price level. That is, inflation started to increase in the second half of the 2021 in many countries. The measures taken, such as loose monetary and fiscal policies, came together with increasing energy prices and food prices. Due to largely the Russian invasion of Ukraine in February 2020. The invasion has had negative impacts on global economic conditions throughout 2022. The main impacts of Russian invasion have become rising fuel and food prices, and then rising inflation and rising financial instability in both many developed and developing countries. As you see, in the United States, in the United Kingdom, in India, Brazil, in South Africa, inflation has increased. Yes, in Finland, also the US is good example relating to inflation. When we look at the inflation rates in last 2 decades, especially in 2020, inflation increases broke historical record, as you see from the figures. With increasing inflation in many countries, many governments have took some measures to control inflation. For example, they use the monetary policy tools, and the governments increase reference interest rates, indicative interest rates regularly, to control inflation by decreasing private demand. Some countries in Russia, China, South Africa, except for increasing, they continue to decrease interest rates, different from many countries. As you see, inflation rates have started to increase in 2022 in the United States, in Japan, in India, in South Korea, in many European countries. As a result, the main reason of rising mortgage interest rates is increasing inflation rates. and the government's measurements to prevent inflation increases. Thank you so much. This is 8 minutes presentation because our limit is 8 minutes presentation.
Thank you, Dr. Akçay. Thank you so much. I really like the global perspective of what was presented just now. It shows that we are not alone in this with what we're experiencing in Jamaica. So we're rolling on because you can save your questions for the Q&A. But we will be moving on now to Dr. Wesley Hughes, and I will introduce him right now. Dr. Hughes, CD, is a partner and founder of High Star Consulting Limited, an adjunct professor of economics, climate change, and renewable energy at the University of Technology, Jamaica, a board director of the Caribbean Policy Research Institute, and the former chief executive officer of the PetroCaribe Development Fund. The wealth of knowledge Dr. Hughes brings to the table is second to none. He served as a deputy governor of the Bank of Jamaica, financial secretary for the government of Jamaica, CEO of the Ministry of Finance and Public Service, and Director General and Chairman of the Board of the Planning Institute of Jamaica. Dr. Hughes is also a Commonwealth Scholar. Help me welcome Dr. Hughes to this webinar for him to share with us a wealth of knowledge that will explain some of the things we are experiencing right now, or to experience. Welcome, Dr. Hughes.
Thank you very much for that introduction. And thanks to ALEVS for inviting me to address this seminar on a very important topic, which we are all experiencing from around the world, as the previous presenter pointed out. So I'm glad for this opportunity. If I may move on very quickly, I have identified 6 points that I want to raise quickly. One, and this is in keeping with what was said earlier, the world economy is at an inflection point with great instability and a point where we will have to change our lifestyles as we go along because of where we are in the world. And we can discuss what this inflection point is like. The second point is that there are major markers. Some were mentioned earlier: climate emergency, the ongoing pandemic crisis that we are facing, and the fallout from the wars and sanctions, which amounts, I would think, to a geopolitical realignment in the world taking place. And thirdly, change and instability leading to higher global inflation, dealing with the 4 Fs, as I like to call them: food, fuel, fertilizer, and finance. And fourthly, Jamaica's place in all of this. Jamaica's inflation rate has risen sharply as a result of what has happened, globally. And the central bank is taking, or has taken, very significant measures to counter this. This is an issue we would like to address also. And fifth point is that the rate of economic activity as a result of all the changes I mentioned earlier is falling. But in doing so, and based on the activities that have been taken by central banks, all asset classes in the country, as well as the overall economy, will be impacted by some of these activities. And the last point I want to make very quickly when we get there is that monetary policy is not neutral. It has distributional, or they have distributional effects between capital and labor. And so I'll quickly go through these points as we go along. The first one is the world economy is at an inflection point. There's great instability and lifestyle changes are ahead of us that we must start to imagine and plan for. The point is that we are seeing a decoupling of economies, not just between the United States and China, but the United States, Russia, Russia and the European Union. Even Brexit is an element of all of that. So we're seeing decoupling, we're seeing deglobalization taking place as trade fracture across the world. And there's a deceleration in growth. So those 3 Ds we need to bear in mind. The second slide I want to look at would point to the emergency. And these we are not out of. Somehow they get shifted to the background. Climate emergency. We see what's happening in Europe in terms of the drought. We see what's happening in China, severe drought. And of course, we saw what happened in Pakistan just a few days ago. The ongoing pandemic, it's not over. And there's a likelihood that more could happen, not just for COVID-19, but other pandemics. So these are presenting significant challenges to the global economy and or global society. Thirdly, we are seeing a change, as we said, in inflation as an outcome affecting food, fuel, fertilizer, and finance largely. There's great upheaval, and we're now seeing where the IMF is projecting low growth for the first time in many, many decades. We're going to see a lower than 3% growth in overall global GDP. And interestingly enough, a rise in inflation coming out of all of this of about 7.6% projected for the year, the highest in over 30 years. So this is real. This is having an impact on the global economy. Next. Where's Jamaica in all of this? Jamaica's inflation rate has risen sharply. And the bank, our newly independent BOJ, and we can say something about that a little bit later, has taken very aggressive action. Just to point out, during the 1990s, inflation was averaging per annum each year 28%. That was what was baked into our head. We expected relatively high inflation and became embedded in our consciousness. A lot of things were done, and that was reduced to about 11% per annum during the 2000s. And over the last decade, we've done even more and reduced this to an average of 5% per annum over the decade. This is a great accomplishment, which came at very, very significant costs. And we can go into some of that. During the last couple of months, inflation has picked up dramatically in Jamaica. It's been above 10% over the last 4 months. And there's been a 550 basis point increase in the policy rate of the Bank of Jamaica to try and cope with that. And this has happened between October last year and August this year. This is a very dramatic increase. Can we move on? Yes. This rate increase is going to have significant effects on all the asset classes, as I pointed out earlier. And just running through them very quickly, savings will become more attractive in cash because of higher interest rates. And that's a no-brainer. However, if interest rates keep being below the rate of inflation, then the real return on those savings will not be there, and maybe the rate of savings will not go up as quickly. On the question of real estate, we heard earlier what happened in Europe and elsewhere. Once there is an increase in interest rates, which then translates into increase in mortgage rates and mortgages become more expensive, you can expect a reduction in the demand for mortgages because wages and salaries are not going to be going up as quickly. And with rising prices elsewhere, people have to divert savings and earnings to cope with that. However, the mitigating factor here is that most people prioritize their mortgages in terms of expenditure. So it may not be as dramatic. However, there will be a reduction once interest rates and the policy rate keeps going up for mortgages and the real estate market to be under pressure. There will be more discussion on that later. Commodity trading, another asset class, is a very risky one. And we don't have a lot of that in Jamaica, but traders do have to take account of this because they have to carry inventory and they have to buy ahead. But it's a very risky business, but it's also affected by increases in interest rate. Once that happens, risks increase, and therefore there is likely to be some hesitancy in getting into that business. Importantly, foreign currency, once there's an increase in the domestic interest rates, especially on the scale that we have undertaken, there's a tendency for the local currency to appreciate. And we have noticed that if you look at the movement in the Jamaican dollar against the US dollar, you'll see a movement, an improvement in the, an appreciation in the value of the Jamaican dollar as domestic interest rates go up. This has a negative impact of us losing export competitiveness, which is a trade-off in all of this. And so that's something we have to watch. On the equities front, high interest rates tend to cause equities to underperform because people look to other investments like holding bonds rather than the equity market. And so the equity market is likely to be underperforming as an asset class. Not all, but generally for the market as a whole. And the final one I want to focus on is on bonds. Bonds tend to perform in a way where when interest rates are going up, people demand higher yields. And because of the inverse relationship, there's a lower price for the bonds. So pay attention to these movements in asset prices. The last point I want to make is that the transition mechanism where the central bank increase interest rates and the overall impact on the society and on asset classes is not well understood, but we know it's very dynamic. What we do know is that inequality tend to increase for some groups and some classes, some households, for example, once there's a significant increase in interest rates. Inequality, of course, remains outside the mandate of the central bank. However, contractionary monetary policy tend to increase inequality. And this is the outcome of studies from the World Bank and the IMF and elsewhere. So it's not something we should ignore. The negative impact of monetary policy actions on households and disadvantaged groups are things we should pay attention to. It's not something that the central bank can address, but it has to be fiscal and structural approaches to tackling these problems. Those are the main points I want to address. And I want to thank you. I hope I didn't spend too much time.
Thank you, Dr. Hughes. That was a mouthful. Yes, that was a great presentation. And I'm sure there are many questions coming in the Q&A for you because you have touched on some very important points. So most of us can relate to. At this time, we will welcome Dr. Tina Beals to the floor. Dr. Beals is a lecturer of real estate and planning at the University of Technology, Jamaica, and currently serves as the Quality Assurance Chair in the Faculty of the Built Environment. She is also a Commonwealth Scholar, a 2021 Lincoln Institute of Land Policy Scholar, a Fellow of the Higher Education Academy, and is the Vice President of the Association of Land Economy and Valuation Surveyors. Dr. Beals' specializations are real estate investment appraisal, public finance, land governance, with a focus on the development and performance of the real estate market. Now it's over to Dr. Beals to share with us some exciting information. Dr. Beals, welcome.
Hi, thank you for that introduction, Mr. President. Good afternoon to everyone. So today I'm essentially looking at, giving a snapshot into the role that our legal framework plays in the performance of our market. So first of all, I'm looking at the housing market as it is in Jamaica, the implications of us having a predominantly informal housing market, what it's like operating with a partial base during COVID-19 with respect to the housing market, And perhaps it is that we also need to rethink about how we conceptualize the housing market in Jamaica. So I'll start. All right, so essentially the diagram that you're seeing here on screen is basically speaking to something which it is that we already know, that our housing market consists of formal and informal segments. The challenge though with us having this duality in our housing market is the fact that we are uncertain of the size of each aspect of, or each segment of this, the two main segments of the market. So in 2019, I believe it was estimated that the true formal housing market for Jamaica basically amounted to 2.6% of our national GDP. But with respect to the informal aspect of the market, we are not sure. Now, the challenge with us not knowing the informal aspect in terms of size and all of what it constitutes is that there can be things lurking in the background that we're not aware of. Can you move on, please? So if it is that there is some limited transparency in terms of formal and informal, then it begs the question of whether or not we can really know market performance in a true empirical sense. Now, what that is essentially saying is that we have an absence of or limited transparency. But in the discussion forum, I'll go in a bit more details in terms of what is the specific role that some of our key legislations play in maintaining this uncertainty. Now, if it is that there is limited transparency within our markets, then it means that our market indicators such as property yields, property rents, as well as values, sometimes can be challenged. You can go back, thank you. Sometimes can be challenged. And as a result of that, then it brings an issue of credibility of some of our market indicators. Now, what we do know, however, is that 60% of properties generally in Jamaica are registered. But of that 60% and the 40% that are unregistered, it may be the case that there is uncertainty, or it is the case actually that there is uncertainty as to whether or not we know all the true interests that are running on the land. And that would be of importance, especially with respect to for tax purposes in our country, as well as being able to identify individuals in the property market. Can you go ahead for me, please? Okay, so here when I speak to operating with a partial base during COVID-19, partiality takes on two dimensions. So it's partiality in terms of having incomplete knowledge because we don't have fulsome knowledge on the two main segments of our market. Partiality also takes on the meaning of inequity. Now, we would have seen in various news reports all across the world that COVID-19 has increased inequalities generally across the globe. So if it is we are already working with a partial institutional base in Jamaica, then with COVID-19 being overlaid or the implications of COVID-19 being added to that, we can expect multidimensional inequalities. Now, with COVID-19, we also know that there are, and our past two presenters basically highlighted this, there are high economic costs. So if it is that there are high economic costs, it's reasonable to argue that, for instance, the middle income group will feel the pinch and the squeeze, as well as those who are at the lower echelons of society. So it's not far-fetched that a long-term implication of COVID-19 could be increasing informality. But in terms of those aspects of our market, the informal aspect, informality generally in the literature is tied to resilience. And what it basically creates here for us is an opportunity to build resilience, which is what people essentially need. Now, how can we go about building resilience in the informal market? Can you move ahead for me, please? Now, if it is that we want to build resilience, especially for those individuals who have a challenge in terms of affordability of housing, then one thing that we could particularly look into is providing land for these individuals, and then let these individuals decide how best to build on the land. Now, that in and of itself can be challenging because, at least from a governmental point of view, because it's harder for you arguably to manage that sort of process. However, if it is, we can develop a new planning framework, not necessarily an entirely new planning regime, but a new planning framework which aligns with that kind of institutional setup, then it may be worthwhile for us to look into exploring that option along with social housing for those who may find housing unaffordable at this point in time. And in doing so, have built-in resilience in the market through the individuals who are actually playing a part in the market, so that we can bolster the informal sector as well as the formal sector. That's essentially my presentation for you today. Thank you.
Thank you, Dr. Beals. Insightful as usual. I know there are questions for you. It was very short and spicy, and there are some terms that we will seek further discussions on, but we are rolling on. And at this time, I will welcome Mr. Andrew Samuel James to the floor. He is an experienced valuation surveyor, realtor, and auctioneer, who is also the founder, owner, and managing director of A.S. James and Associate Limited, a full-service real estate company which opened its doors in 2004. As a sole proprietor and later transitioning into, he opened as a sole proprietor and later transitioned into a limited liability, a limited company. Mr. James has a wealth of experience in real estate industry, having spent several years in both private and public sector. He is a director of several boards, including the Real Estate Board and Commission of Strata Corporations, of which he now sits as the chairman. So help me welcome Mr. James, and his role here now will be pulling together some of the information we have heard earlier. So we're taking it right home to the real estate market right now. Over to you, Mr. James.
Thank you, Mr. President, and welcome to each and every one. I just want to say thanks to the council members of ALEVS for inviting me to share with you about pre-COVID and during COVID-19, the effect of the mortgage rates. Now, I can remember in January 2019, I was at a function, and I said to the realtors there, 2019 is poised to be the best year for real estate. And of course it was. 2019 was good, then went to 2020. Then something in COVID-19 where it's ugly head. And at that point, between March, April, May, most persons wasn't sure what was going to happen. So everybody freeze. What you find is that the investors say, hold on, let me hold on to my money, because who knows, with people losing their jobs and so on, I might be able to take advantage of foreclosures and so on. Those persons who wanted to buy a property, let me hold on a bit, maybe now it's not the right time. So there's a lot of uncertainty in the market. But July, August came and people realized, hey, this thing seem as if it's here to stay. So guess what? It doesn't make sense I keep my money in my pocket. I need to now invest the money, right? So persons started to buy real estate again. People start to invest all over again. I can remember someone saying to me, the stock market looked a bit shaky during that period, but the real estate market was there. House prices didn't drop because, again, demand still exceeds supply. So the market picked up again and it was doing extremely well. And now we're where we're at. We're come between 2021 and 2022, the BOJ in its wisdom, decided that with the whole thing with inflation and the amount of money being spent, the best way to just increase the rates. I just want to, before I go any further, let's look at mortgage rates between 2000 and 2021. Now, they're coming from a high of 30% to a low of 78%. That is significant, right? Look at the commercial banks, building societies, and what happened during this period over the past 2 years with interest rate being so low, persons who didn't think it's possible to own a property now see it possible, right? I remember back in the days, most persons can remember, if you want to buy a property, you would have to find at least 15 to 20% deposit to own that property. Now, with the reduction, with the government in its wisdom, reduction of stamp duty and transfer tax, now persons now can find as little as 5% to deposit on a property, right? With interest rates being 7%, 6%, the banks are actually dropping an additional incentive for persons to invest in real estate, right? So it was a very good time during the pandemic, which is unbelievable. So another thing we realized was happening over the period is that people in the diaspora started to invest more into real estate, right? So one, the locals are able to buy real estate because of low interest rate, and people in the diaspora also, and I guess since the time of Donald Trump, a lot of people in the diaspora decided, hey, I need to invest back into Jamaica. I need to own a piece of the rock. And so demand again continue to do more than supply, because developers could not build enough properties to meet the demand of the public. So that was, again, I also want to point out to you, NHT play a critical role during this period, right? So as you know, realize they had increased, in 2019, they had increased the loan ceiling from 5.5 to 6.5 million. And then during 2020, they also really reduced by the loan by 1%. So all these things, I mean, the real estate market was red hot, and it continues. Now with the increase in real estate, in interest rate, and this is my final point, increase in interest rate, my concern is that it will affect a small small sector. And let me explain what I mean by that. The demand is still increasing, because what you find, a number of persons in the diaspora are not actually taking a loan to buy some of these properties. Okay? It's cheaper to buy a property in Jamaica than in, say, Florida or, say, in other parts of the Caribbean, right? So they are finding, investors are finding Jamaica the ideal place to invest. And I say to people, make the investment now. Do not hesitate. Now is the time to invest. The interest rates might go up, but I'm confident that it will come down in a short time. Okay? But let's watch the market and see what happens from here. Right? Remember, guys, the time to invest in Jamaica is now. It's still, the market is still right. So Jermaine is still laughing because he knows they're calling him each day to the valuations. Jermaine, has there a reduction in the valuations that you do?
No, we have not been experiencing any reduction.
Not, right. And the real estate board has not seen a reduction in the amount of developments taking place. So guys, it's still a good time to invest in real estate.
Thank you, Mr. James. Thank you. Always energetic as usual. Beautiful presentation. Several questions coming in the Q&A for you as well. All right, so it's now time to welcome our final presenter, Miss Diane Campbell. And Ms. Diane Campbell currently serves as the acting branch manager of Victoria Mutual Group, UTech branch, and she's also a realtor attached to Victoria Mutual Property Services. With over 14 years of experience in banking, sales, and management, she has been with the Victoria Mutual Group out of that 14 years, she has been with the Victoria Mutual Group for 7. She currently serves as a youth mentor with the VM Youth Mentorship Program, and she is also a member of the VM FET Ambassador Program. She's passionate about helping young women maneuver the challenges of adulthood and helping her clients and team members achieve their financial goals. So it's time now for Ms. Campbell to grace us with her presentation. And, you know, we say, I know they always say we save the best for last, but Ms. Campbell, that's a heavy weight on your shoulder right now. Over to you.
Indeed. Good afternoon, attendees and colleagues. I will be sharing today on the impact of rising mortgage interest rates on borrowers and lending institutions. Let me just also say that the views expressed here are solely my own based on my experience in the field. These are some of the topics that we will be covering today: the impact of inflation and rising mortgage rates. How has COVID-19 affected the housing market in Jamaica, and how the rising interest rates affects the local housing market? What are the credit risks caused by COVID-19, and how financial institutions manage credit risk? And finally, strategies to help borrowers in times of economic uncertainty. All right, so our first presenter already spoke about how the interest rates actually rise and how it affects mortgage payments. So I'm just going to jump into how has COVID-19 affected the housing market in Jamaica. The demand for housing increased during the pandemic as people sought for housing solutions that were more suitable for families. For example, single family dwelling or bigger spaces. The shutdown and stay-at-home orders brought production and shipping of goods across the world to a standstill, with this resulting in an increase in the cost of goods and services. As most of us would have observed, including myself, construction costs increased and shipping and transportation costs increased. So I've had experiences where persons would have ultimately desired a certain amount to build a particular structure, and they had to seek further financing to complete the structure based on the fact that the prices had increased. You may continue. Second slide is how the rise in interest rates affects the local housing market. Higher interest rates means higher monthly payments. Potential borrowers will find it difficult to be pre-qualified for mortgages as the cost to finance a property is now more expensive. And as such, they will have to explore other options to achieve their goal of home ownership. Some persons will have to seek to join with friends, spouses, or family members, or look into the option of getting a second source of income. The housing market also currently favors buyers who are prepared or those who have cash to do the purchase, as they can wage a bidding war. Many prospective purchasers may also consider delaying the process due to the uncertainty with the economy and what may happen with their income. They may consider holding on to their savings for emergency purposes. Existing borrowers may also need to seek additional sources of income to service their loans. Let's continue. Now, we're going to explore what are the credit risks caused by COVID-19. Credit risk is simply the potential that a borrower will fail to meet the obligation in accordance to the agreement. And this itself may lead to a default risk, where the buyer or borrower is unable to make the payments. This may also lead to delayed payments, which may incur late fees for the borrower. It may also lead to foreclosure of the property, loss in revenue for the financial institution. And important to note, late payments negatively affects a borrower's credit score and impacts their ability to get more funding in the future. How can financial institutions manage credit risk? Effective methods for measuring credit risk can reduce potential losses and will help banks make better loans. Now, of course, all financial institutions are engaging in these 5 steps outlined, but they now have to be a little bit more prudent and conduct in-depth analysis of and evaluation of the borrower's credit history. They may need to calculate debt-to-income ratio or go deeper into the borrower's financials to estimate resilience, which is key during this time. Thirdly, they will need to evaluate the potential debt of the borrower by analyzing the demand shocks and recovery to translate the probability of default. And to break this down, it means that not only do you have to present an acceptable debt service ratio, but it is good when borrowers have savings outside of what they will require to facilitate the purchase, as it shows that they can sustain shocks to their finances. And fourthly, they may implement risk mitigants to reduce probability of default, and these may include automatic payments through standing orders or salary reduction, liens on future receipts, and guarantors. Banks and financial institutions will have to consider a shift to customer assistance interaction model and make this a priority. Help borrowers to reduce their debts and provide pertinent financial education programs. Strategies to help borrowers in times of economic uncertainty. Financial institutions can help offset anticipated economic effects of the pandemic through offering longer lending periods to help maintain affordable monthly payments. And let me just say here that Victoria Mutual Group offers one of the longest lending periods on mortgages currently that is in alignment with the national NHD, and that is up to age 70. Secondly, they can offer clients fixed mortgage rates so buyers can opt to lock into lower rates before interest rates increase. And also to prioritize, I believe that is another point, to prioritize financial education to purchasers. Also, continued lending to businesses and consumers to help to spur economic activity and extend support to those in need. A lot of financial institutions hold back during times of economic uncertainty to, I guess, avoid the level of exposure and to minimize their risk. But we're saying that they would need to continue to lend in these times to help build back the economy. And finally, encourage borrowers to prepare for situations like this, COVID-19, by paying off high interest paying loans. They can also defer payments and interest on loans and credit cards. They can extend credit limits and payment deadlines, waive late fees, and lower minimum payments. These are extraordinary times, and financial institutions can go even further to consider new, unique, and unprecedented actions to assist persons in the economy. And that concludes my presentation, ladies and gentlemen, colleagues, attendees. Thank you. Enjoy your day.
Well, we're not finished with you as yet, so don't wish us off. Don't wish us off. Thank you, Diane. Thank you for that. We are now at the Q&A session. I invite everyone to upload your questions in the chat so we can try our best to address them. We are not doing so bad on time. I really thank my presenters for adhering to the time limits. We have gone through all 5 presentations. I've learned a lot. So let me just open up for the panel discussion while we will address the questions at the same time. So if we backtrack to Dr. Akçay's presentation, she had shared a global perspective of how the markets in Europe and the Americas performed during the pandemic and what's happening after the pandemic. But I would really like to hear how did we manage to maintain a level of stability in inflation during the pandemic when the uncertainty was probably at the highest. We're at a stage now where we can actually see a pattern, but at that time it was so much uncertainty and things somewhat in Jamaica didn't get out of whack. Our graphs also show that there was some amount of stability in that period. I would want to know, how did governments across the globe, were able to achieve this? Dr. Akçay, you want to take that one on?
Sorry, I couldn't hear the last sentences.
Yeah, I said based on the graphs that you shared, there seemed to be some amount of stability in terms of the inflation rates across the globe in the midst of the pandemic, when the uncertainty was at its highest. How did we manage our governments manage to maintain that?
From European perspective.
Repeat that?
Your question relates to the European perspective or generally?
General.
Especially most of countries, inflation is nightmare to manage economy.
Mm-hmm.
Because of this, for example, when we look at the developed countries, when inflation started to increase, they immediately started to take measures to control the inflation. But to control the inflation is not easy. Also, there is the cost of social life, or the cost of there is cost for economy. In this case, managers decide to have to cost, how much cost, and how to manage. But when I look at I know better in the EU economy.
Mm-hmm.
When I look at the EU economy, they use monetary policy tools, and they started to increase, because in the EU financial stability target is financial stability target is 2%, about 2%. But average inflation now is 7%. But in the during the COVID period, it is not easy to control the inflation. Because they supply a big size of loan guarantees. They gave guarantees, and then wage increases, and also they still give the support to people because of increasing energy prices.
That's correct.
I think if also they try to their economy doesn't face recession. and they should prefer, they should select two options. If economy entered the recession and durations can be long, or recession can be short.
Mhm.
When we look at the current case, their economy entered the recession, but what is the duration? All stuff depends on the external conditions also. Russian-Ukraine war. I think the European countries, most of European countries, are the most affected countries by war.
Yeah.
Because most of EU depends on the energy importation. And also food price are affected, not only because of war, also climate change.
Mhm.
In this case, governments or EU institutions will support to control the inflation, but they don't implement very strict measures.
Okay, good, good. Yeah, all right. Yes, I really think I really can remember where there were a lot of government intervention in the pandemic to kind of to control the level of excitement in the market at that time. We would have seen a lot of that playing out in the America's market, where governments had lent significant support, even in the Jamaican local market here, where the property market, particularly for commercial rentals, there were a lot of intervention by landlords and such to keep these buildings operational and not empty, because all businesses were feeling the effects of the COVID pandemic. All right, so let me bring in Dr. Hughes, as he mentioned something very, very important about the interest rates going up, and the people would now look at savings as an option. And how would that impact the equities market now that savings may be more or become attractive again? So Dr. Hughes, you want to just shed some more light on that?
Thank you very much. Just a brief comment on the inflation question. If you recall, there was significant fall off in demand for almost every product across the globe. People were just not consuming. They were not able to go to restaurants and bars and entertainment and recreation or the mall. So there was a significant fall in demand. Even though they had money, there was no demand for goods and services, and therefore inflation came down. There are two sides to the inflation question: the demand side and the supply side. So while governments were in fact doing things to help consumers and different sectors, the inflation question remained suppressed, or inflation remained subdued, because there was so little demand. The moment there was a movement away from control of COVID across the globe, and demand started to pick up, and there was no goods in the market and in the mall and where have you, prices started to go up. So inflation took off long before the war in Ukraine, because demand was picking up ahead of supply. So the supply was not able to respond. And so you had this lag time between demand, supply growth, and actual delivery of goods. And so prices were in fact going up. So that's something to bear in mind. It's a very dynamic issue. that we have to focus on, the demand side, the supply side. The question is, can the central banks just simply raising interest rates affect inflation in the context where governments don't really control the levers that are driving inflation now, like supply side disruption, supply chain disruption, energy prices, war. Central banks don't deal with those things. And if they're really going to use monetary policy to control inflation, they will have to raise interest rate to such a very high level that it will choke off economic activity and therefore push countries into a recession just to control inflation. These are huge issues of debate, and it's showing out what can happen on the equities market, say in New York or wherever. So these are not settled issues, but it's a little bit more complex than sometimes we are mindful to think of. On the question that you raised about savings, with interest rates going up, there's always a tendency for people with cash to save a little bit more. As I said earlier, if the rates are not sufficiently high to make the real savings rate positive, that is, interest rates are higher than inflation, then you're not going to get the full effect of an increase in savings, because people will still be losing value on their money. And so it's a question of what's happening to inflation, what's happening to people's expectation about inflation, because that's one issue I want to address again. The central bank is increasing interest rates now because it takes 18 to 24 months for the policy change to have its full impact. So what's happening now is not going to have the full effect until about end of 2023, because that's how the transition mechanism works. It takes some time. There's a lag between policy change and the full impact on the market. What you don't want, however, is for people to get in their minds that no one is paying any attention to inflation. Because if that high level of inflation becomes lodged into people's behavior and their mental state and their psyche, then inflation will take a very long time to come down. We saw it, as I pointed out, for a very long period of time. Inflation was averaging over 20%, and it took a long time for people to get that out of their minds and to come down to 5%, where inflation was no longer the topic of the day and people were able to adjust. But if 10 or 15% becomes lodged in our psyche, it's going to be much harder and take some longer time and maybe tougher measures.
All right, thank you for that, Dr. Hughes. All right, we are just rolling through. I would now ask Tina, Miss Dr. Beals, just to give us a clear definition for the informal market. You had mentioned the formal and the informal market. It seemed a little high level. I want everyone to understand what you meant about the informal market. So, shed some more light on that.
Okay, so when I speak to informality, it's actually multidimensional. So you can think about it in terms of properties, well, unregistered properties. Some persons think of it from that perspective. You can also think about it from the perspective in terms of property rights. So it can be the case that you have informal interests on formally registered land, as well as that can also be the case for unregistered land. So you can look at it in terms of property rights, in terms of the interests running on the land, as well as you can look at it in terms of land not being formally registered as being a part of the informal sector.
Okay, understood. Thanks for that. And Mr. James, so James, you mentioned about the property market being it is being one of the strongest participants in the local property market are people in the diaspora internationally, right? Do you think that the exchange rate plays a major role in this?
would. It would. It would. So, but that's just one aspect when I spoke about the property market as it exists now, right? The other part has to do with persons are investing in real estate as a means of making additional funds. Take, for example, if you should go into a new development, right? Chances are, if you hold out to the end, and we're talking about, say, a property might come on the market, say, for 20 million. By the time that development is completed, the units might be selling for 30 million. There and then you could make 10 million on your money. You understand? So sometimes I hear this argument about, yes, about sometimes I've seen apartments empty, but people are making the capital value. So it's not just the income in terms of, say, I rent out the unit. Chances are I rent out the unit and the person who rent the unit might destroy the unit. So people are finding creative ways and means of making money out of real estate. The Airbnb market, again, is on the rise because with flights coming in and so on, you find that persons are looking at alternative, or I don't want to use the word cheaper way of vacationing, you know? So there's so many ways of making money and people are doing this. I find that the younger people are investing in real estate more than back in my days. So like an old man now, right? But so they're seeing the opportunities and taking advantage of it.
Okay. All right, and I'm going to pose this question from David Thwaites to Diane Campbell. What are the typical mortgage/equity rates? What is the anticipated rate rise in the near term?
All right, good afternoon again, colleagues, panelists. The average market rate now for mortgages range from 8 to 8.5%. We cannot definitively say if and when the interest rates on mortgages will rise. So as such, we continue to watch the market, but we can't definitively say, yes, it will rise, how much it will increase to at this time.
Okay, and this question may Diane or Mr. James, you can take this question, but as it relates to the increase in mortgage rates and the anticipated increase in the rate of foreclosures, do you think this will increase the supply to on the supply side of the market and somewhat slow the growth of the rate of appreciation that we have been experiencing since, I would say, from 2017?
Well, financial institutions are taking the necessary steps to do what they can to support the consumers as it relates to foreclosure. And this may include offering payment holidays, or what we call a moratorium, which is a break in the payment. So we're not quick to foreclose on a property. We still see that is happening, but that's not something that is rapid, so to speak. But it's still happening. Financial institutions are being prudent to assist their clients in maintaining their mortgages.
Just to add, and I agree, the banks play a pivotal role during this time. Like during the pandemic, I mean, the banks, they're calling their customers, you have a problem, come and talk to us. That play a critical role. And if the banks continue to do that, then, I mean, I don't think we have much to worry about. The problem now is if the banks increase the rates, sometimes and don't communicate to, hey, your rates have been increased, right? And what I've found is that when interest rate fell, sometimes you have to call the bank to find out, can you reduce my interest rate? But when it's increased, they don't call, they say, hey, your interest rate went up, let us try and work out something. So those are the things. If the banks are more proactive, I'm sure the real estate market is here to stay. And some people talking about a burst. I don't know about any burst right now.
Yeah, because I was about to forward this question to you, Mr. James, from Christopher Moffat, where he said, I hear Mr. James saying real estate sales is booming. Is that boom occurring in all aspects of the real estate market? And he refers to the industrial, agricultural, resort properties, and so on. So the boom you refer to, is it all across the board? Are we seeing any drop off in any categories of the market?
Well, I can say that there's still a great demand for low to middle income properties. And my only concern about that is that the higher the interest rate goes, it might be a little bit difficult for some persons to own that property because but people are finding ways. What you find, people are now, instead of Andrew James, buying a property by myself, I might join with a cousin or a family member, and two of us buy this property, and we find a lot of that's happening now. So people find creative ways. You know, Jamaicans have this thing, you know, I need to own a piece of the rock. I need to own my own home. And so they're quite passionate about this. And so based on that, I think the demand will continue. People make the sacrifice to make it work.
All right. So I bring in Dr. Hughes at this point. I want to ask Dr. Hughes, given the increase in mortgage rates, increase in interest rates in general, inflation rates and such, one would want to think that the property market will get a direct hit. But in Jamaica, we have a unique situation where we have in the lower to middle income sector of the market, we have undersupply. How do you see this playing out? Because there's this perception that the demand is greater than the existing supply. So with increasing rates, do you anticipate, what is your anticipation? No change, everything, people will find a way, as Mr. James say, or what will happen?
Well, I'm not really the expert on the real estate market. I tend to focus more on broad general economic trends and to surmise how this would impact real estate or other asset classes. From a general perspective, you know, just speaking generally as an economist, once interest rates go up and they translate into higher mortgage rates, you may find, or more than likely will find, a decline in the demand for mortgage property, whether for land or for building or housing, so to speak, or commercial property. Jamaica, as you said, is a unique environment. We were discussing earlier the informal sector, which was estimated at one time by the IDB to be roughly about 30 or 40% of the total economy, not an addition, but that component of the economy that is not readily accounted for in the formal sector, but is part of the overall. It's about 30 to 40%. So we don't know how savings take place there fully. Some of it is outside of the formal banking system. And so some of that money would go into housing. And we see that where people build their housing, the housing stock over many, many years. Where I live now, there's a house that started when I moved here. And it's 20 odd years now, and it's just about 75% completed. But there are people living there, and this person has no mortgage, but they're building over time using their own resources as they go along. This is typical. So housing in Jamaica has a different dynamic from in Europe or any developed society, where you simply go into a mortgage institution, get money, and buy a house or property as a complete product. It's a little bit different, as we know here. So it's very difficult to pinpoint the relationship between interest rate movement into mortgage rates and into the demand for housing. But you can say that despite the positive that we're getting from the people who are in the market, that there will be a tendency, there will come a tipping point where if the rates become too high, then there will be a fall off. There's another element which I quickly mentioned, which was touched on, that much of the demand is being driven from outside of Jamaica. We hear of the diaspora, but there's also an underground element to that, an informal component of that, which I don't have a handle on and I can't speak to, but it is there. We have seen comments from the central bank which says that the amount of cash being generated in the economy, US dollars, is above what they would expect from the normal business activities. And that's a euphemism for saying that there's something amiss in the inflows of resources into the Jamaican economy. Experts can, take that on more formally, but I do know that is keeping up some of the demand, not just for housing, but for other commodities in our economy. And so interest rates going up may not have the same dampening effect as we would expect in a normal business environment, business context, or economy. So it's very difficult to predict, but we do know that there's a tipping point. Once it goes too high, it will have an impact on the demand for housing for different segments of the market.
All right, thank you for that. And on that note, I'll return to Diane Campbell to just explain to us how this increase in rates have been affecting the pre-qualification exercise.
Okay, thank you. So what we have noticed is that because the mortgage rates has gone up by about 80 bips or 80 basis points, we noticed that that has affected the average mortgage rather, by about $5,000 thereabout. And for persons who, that's for existing mortgages, so persons who are trying to become pre-qualified, what they will do is to scale back on other areas such as entertainment or other things that they do not deem as mandatory to enable them rather to become eligible, or they'll explore unique ways to become pre-qualified, which we mentioned in the presentation, may include joining with a friend, family member, or spouse, or starting a business to get extra income in order to become eligible.
Yes. Let me put this to you as well, Diane, because during the pandemic, some extra income were disregarded by some financial institution like rental. You want to just shed some light on that as to why this was the case?
Right. So we had to take the decision to not rely so much on that source of income, such as rental, because it became very unpredictable in that season. We noticed that landlords were having issues collecting rental income. In the United States, sorry to segue to that, they had a payment holiday for at least a year. Some landlords gave their tenants a break from paying rent for at least a year. In Jamaica, we noticed also that some landlords were a bit lenient with their tenants because of what was happening. A lot of persons were becoming laid off from their job based on the industry that they operated in. For example, those in the tourism sector, a lot of those persons were laid off during the peak of the pandemic. And as such, landlords became a little bit lenient. So we couldn't rely so much on rental income as a source of income during that time because, one, we were not sure how long the pandemic would have continued for and how consistent this source of income would be during that time.
Thank you for that. And Mr. James, there's a question in the chat which speaks to statistics as it relates to demand pre and post pandemic. Do you have that information, or can you comment on the performance of the real estate market post pandemic?
Okay, so what I speak of is information I gather from the Realtors Association through via the MLS, and also information from the Real Estate Board. And we looked at the demand in terms of the development going on, the amount of properties on the market, properties being sold. So it's basically looking at what is happening in that sector of the market. That's something that I hope Jamaica will get to some point where we start to capture data and so we can make better decisions. All right. So that is one of the weaknesses we have as a country. But you know, sometimes people don't want to share information. If you have the form and you say, hey, you buy this property, tell us, give us some information. People don't want or reluctant to give information. Right?
Right.
So that's the information I'm using to justify what I'm saying.
Okay, all right. So we are now at the 90 minutes time slot that we had allocated for this session. We started a few minutes after the start point to allow more and more people to check in. So I want to thank my presenters, but at this time I will invite Mr. Javon Reed to do the vote of thanks. Mr. Javon Reed.
Thank you, Mr. President. Good evening, everyone. President, Mr. Jermaine Williamson, the members of the executive of the Association of Land Economy and Valuation Surveyors, our most valued invited guests, our speakers and attendees. It's my privilege to have been asked to propose a vote of thanks on this occasion. I, on behalf of the Association of Land Economy and Valuation Surveyors and the entire organization team, crew, and technical support, extend a hearty vote of thanks to all speakers and our moderator for sharing your important work, expertise, and time with us today. We wish to especially thank Dr. Sariye Belgin-Akçay for sharing with us insights on the impact of rising mortgage interest rates on housing markets globally. Dr. Wesley Hughes, CD, for shedding light on the differential effects of Jamaica's monetary policy. And Dr. Tina Beal for discussing how the legal framework of our real estate market influences its performance. Mr. Andrew James for so ably giving us a rich first-hand insight on the operations of our market pre-COVID and during COVID. And lastly, Ms. Diane Campbell for giving us a thorough understanding of how the banking sector has responded to the COVID-19 pandemic. The Association of Land Economy and Valuation Surveyors would especially like to thank Mr. Lloyd Davis, a fellow of the Royal Institute of Chartered Surveyors and consultant at Allison Pitt and Company Limited, for bringing to our attention the pioneering work of ALEVS through its members. The pioneering work, my apologies, of ALEVS through its members, which it has undertaken since its existence. Last but by no means least, the association thanks the organization team. President, Mr. Jermaine Williamson, who provided thorough leadership and demonstrated his strong command of marketing in executing this event. Dr. Tina Beal, who managed the overall coordination of the event. Mrs. Rochelle Channer Miller, Mr. Andrew Miller, and Mrs. Alisa Whiteley, and Mr. Daniel Tollereed, the event's leaders on technical support, and the members of the executive who played an integral role in the marketing of the event. Thank you. It goes without saying that the event would not have been possible without the support and interest of our valued attendees. We thank you all wholeheartedly and look forward to seeing you at our webinars in the near future as we continue to promote excellence and professionalism in property valuations. Godspeed and best wishes to you all. Thank you.
All right, thank you for that, Mr. Javon Reed. All right, so I don't want anybody to feel left out. Your questions in the chat, we will take note of those questions. We'll compile a document and try our best to provide answers for those questions. We have your email address, so we'll share the answers for the questions via email. So you should not feel, we're working with a strict time, and we weren't able to have all the questions in. We have people from different time zones and we must be respectful of that. So your questions will be addressed. So I will now draw your attention to save the date for Thursday, September 29th for our next webinar. And this will be a very, very interesting topic, a masterclass on restrictive covenants, restrictions, breaches, and modifications. So I want to thank you all. Again, I want to thank each and every one of my panelists. You have all brought some light to this, this, I would say, dimension that we are now heading into locally. It is Dr. Akçay also shared that this is not a local issue only, it's international. Also, Dr. Hughes confirmed that. And somewhere in Mr. James' presentation, he also touched on the international aspect of influence on our local market. I want to thank each and every one of you, Dr. Beals, Diane Campbell, for your very insightful presentations, and we look forward to working with you more. I want to thank the attendees because this webinar would not be possible without you. I want to thank my exec for the support and the organizers. So I wish you all a good rest of evening, depending on where you are, rest of day, and thanks. So you take care and walk good.
Thank you.